Let's talk about safe withdrawal rates and the 4% rule. I want to look at the origins of the 4% rule, other data that's come out and studies on it recently, some of the drawbacks, and whether that rule makes sense in today's environment. My name is Scott Caulfield. I am a CPA and a CFA charter holder, and I am the founder of Sophos Wealth Management. So, the 4% rule was created by Bill Bengen, a financial advisor back in 1994. And he put out a research paper that studied historical data on investment returns and inflation. And what he found was that if a retiree took a 4% withdrawal rate on their investment portfolio, that portfolio would have lasted at least 33 years in every historical scenario up to that point. And in fact, in most scenarios, that portfolio would have lasted 50 years or more. So that's where the 4% rule came from. Now, if you kind of put that in practice, imagine somebody had $1 million portfolio. In the initial year they retired, they would have taken a $40,000 withdrawal. If inflation was 4%, they would bump that withdrawal up by 4% the next year, and then so on and so forth. Now, that rule has kind of been studied a lot ever since. There was the Trinity study famously. Now, that took into account more asset classes, and it was done by 3 professors. And that more or less confirmed that, hey, a 4% rule has been really successful in the past. And one of the things I actually wanted to point out was this chart from McLean Asset Management, and they updated Bengen's data through 2010, and they came up with this chart showing the maximum withdrawal rate depending on the year that you retire, and you can see it's kind of been up and down anywhere between 4% and as high as 8%. Kind of depends on what investment returns were over the 30 years, and very importantly, how high inflation was. One of the most damaging things to safe withdrawal rates is high inflation, especially early on in retirement, because that bumps up those withdrawal rates early and it makes it difficult for the portfolio to keep up. Another thing that can be very challenging is big market drawdowns, especially early on for retirees. Now, some of the limitations of the 4% rule, it's based on historical data, not future projections. So we're assuming that the past, or that the future is going to look like the past. But obviously, as advisors say all the time, past returns are no guarantee of the future. The study also assumes that there was a fixed asset allocation. Bengen's original study looked at 50% stocks, 50% intermediate government bonds, and then that rebalanced at the end of every year. Now, it also assumes that investors don't have fees and that they don't make mistakes. And you see this all the time if you look at what market returns and what, say, a 60-40 portfolio returned versus what the average investor earned. In almost every study, the average investor earns quite a bit and sometimes drastically less because of bad behavior. They get too aggressive at market tops. When the market crashes, they take their money out and they go to cash right when they should be doing the opposite. So, those kind of things are really challenging to these kind of rules. Now, Morningstar came out in 2021 and then at the end of 2022 with their own research. And it was a paper called The State of Retirement Income. They had much, much more bearish numbers for safe withdrawal rates. And if you look, here's a chart that kind of shows where their best and worst withdrawal rates have been historically. They've got data from 1927 through 1992. And they only put a 90% success rate on it. But you could see some of those worst withdrawal rates were like 3.1, 3.3, even 3.7%, depending on the allocation between equities and stocks. The difference between what Bengen did and what Morningstar did is Morningstar used Monte Carlo simulations on past data. So it wasn't the actual scenarios. So in some of their Monte Carlo simulations, they used data that provided a worse outcome than what actually had happened in the historical data. Now, I actually find it interesting. So Morningstar has now come out at the end of 21 when stocks were kind of at their peak and interest rates were still near zero. They were saying that the safe rate for a retiree, the new 4% rule in their eyes, was 3.3%. Following the market pullback in 2022, they updated their paper and they're now saying a 3.8% rate is the new safe withdrawal rate. And a huge part of the change in their analysis came on what they assumed equities would return. In 2021, they had equities returning anywhere from 6 to 10.5% over 30 years. And in 2022, they updated that to 9 to 12%. I find that kind of bizarre, to be honest, that the numbers would have moved that much, given that 2022 stocks were down 22%. That's not just a huge move to bump up 3 or 4% a year over 3% a year over 30 years. Doesn't make a ton of sense to me. But Bill Bengen actually came out and kind of rebutted their paper. And one, he just didn't really agree with their equity assumptions. But he has actually updated his research with more recent data. And he updated the asset allocations as well. So instead of just 100% large cap US stocks, which is what he did in his initial data, he's now included things like small cap and international stocks. And what he has found is that the safe withdrawal rate is really more like 4.7, 4.8%, at least historically. And I find it interesting. So if we kind of fast forward till today, and we think, what is the right withdrawal rate for today? And I think for me as an advisor and somebody working with retirees, that is the most important question. I think when you look at safe withdrawal rates, it comes down to three things. So one, what are the equity returns going to be like in the future? Two, what are your fixed income returns going to be? And three, what is the inflation rate going to be? Now, there's plenty of research on market valuation and its impact on future returns. One of the most used metrics is called CAPE, or cyclically adjusted price earnings. And if you look at this chart, this would show where CAPE ratios are today. And what you can see is we are at some of the most expensive levels in history. And what you find is, not surprisingly, when CAPE ratios are high, future stock market returns are lower. And when CAPE ratios are low, future stock market returns are higher. And the correlation is actually stronger for real or inflation-adjusted returns than it is for nominal returns, particularly over, say, a 10 to 17, 18-year window. That is where it has some of its highest predictive power. And that's very impactful for somebody setting a safe withdrawal rate. So this chart would indicate, well, at least based on equities, we'd want to be very cautious with our withdrawal rate. Now, the red line on the chart is showing where the long-term bond rates are. We're a little over 4% today on, say, a 30-year government bond. That's roughly an average with where it's been historically. It's obviously been much higher in the late 80s, but maybe we'll get average-ish future fixed income returns. Now, what I found interesting, when I entered this and I thought, what is the safe withdrawal rate? Knowing that I'm very bearish on valuations and stocks, I thought 4% sounds like it's going to be awfully high. And I was listening to some interviews with Bill Bengen, and I was surprised that he actually is also very bearish on equities. In fact, he was talking about his personal investment portfolio, and he is currently 20% equities was the number I heard him give. That might have been at the end of 2021. That being said, as bearish as he was, and as much as he thinks equities are very richly valued, he thinks those really expensive equities probably only take off something like 20 basis points from that safe withdrawal rate. So if it was 4.7, it might be more like 4.5%. When I look at it, given the fact that I am pretty nervous on valuations, I'd really just go back to thinking 4% is a pretty great rule. It's kept everybody safe. It kept you safe through the Great Depression. It kept you safe through the inflation in the 1970s. It has still worked through the tech bubble, through the Great Recession. And the other factor that I look at is I think it is much easier to adjust your spending higher than it is to adjust it lower. So if you start out with a 5% withdrawal rate and investment returns are poor or inflation is higher than expected, I think you'll find it much higher to dial it back than vice versa. And oftentimes, we just get fixed costs become or so oftentimes our spending becomes sort of fixed costs. If you buy a nicer home, a nicer car, those payments, you don't really have a lot of flexibility there. It is far easier to downsize or far harder to downsize that than it is to say, hey, I'm going to take an extra trip. Hey, I'm going to do this other thing. So, I just come back to that 4% rate. I think makes a lot of sense. I think as we've seen more and more data on it, if we were in a normal valuation environment, you might argue that a 5% or even higher rate should be safe, and I think a lot of data supports that. But given where valuations are today, and that we're starting at a reasonably high inflation rate today, I would recommend 4% or lower as a safe withdrawal rate. If you want to talk about your retirement or your withdrawal rates, I am happy to do a consultation. You can just click on my links below, and please like and subscribe to this and let anybody else you might think benefit. Feel free to share it with them. Thanks a lot.